Look at key rate duration. And as I was telling you earlier, that this topic is covered in more detail at level 2. So if you feel a little bit confused, it's okay. At this current level, you don't need to understand this in that much detail. Just try to understand a high level perspective here, that this is your yield curve, right? Which usually is upward sloping in normal times. And for different levels, what does it show you? For different maturities, it shows you the yield. And now in normal times, it is upward sloping, which means that for higher maturities, investors require higher yields. But at times, what happens is, let's say we're going into a period where the government is increasing the short term interest rates, right? So let's say for less than 1 year, or the 1 year rate, or the 2 year rate, these rates are going up. The short end is going up. Less than 1 year, let's say the money market securities that the government is selling, the rate on that is going up. So the short end can go up, while the long end might not be going up, because the long end is more influenced by market participants, what they feel is going to be the interest rate in the long run, and that is based on their long run inflation expectations. So again, I mean, you might be feeling a little bit confused here, because this is a complicated area, and you will develop a better grip on the yield curve as you move through your level 2 and level 3. But what I'm trying to explain to you over here, that the yield curve doesn't always have parallel shifts, that it doesn't parallel shift upwards or parallel shift downwards. What could happen is that the short end could be going up, whereas the long end stays the same, or maybe the long end comes down, or maybe we have something called a butterfly shift, which the middle end, the belly of the curve, is going up and down. So for non-parallel shifts, what happens is that the rates for different maturities, they are not changing equally, right? In parallel, it would change equally. But let's say if the long end is staying the same and the short end is going up, so then your 1 year rate is going up, your 2 year rate is going up, but your 3 year and 4 year is not going up that much. And if you were looking at the sensitivity of your bond, now we know a bond can have different payments at different years or different times, right? So if let's say there is a bond, it has a payment in the first year, a payment in the second year, and the payment in the third year. And if the third year rate is not changing that much, but as the 1 and the 2 year rates are changing, so they are going to impact only those cash flows. And so far, the type of convexity and duration measures that we have been looking at are not really taking the year-wise cash flows into account. They're assuming parallel shifts in yield curves, right? But reality is that there are hardly parallel shifts in the yield curve. You either have the short end going up, the long end coming down, or there's various types of different yield curve changes that you will learn over the course of your CFA studies. But this is where key rate duration becomes important, because here what we see is we take year wise data and we check the duration year wise, right? And why is this helpful? Because if the yield curve shift is not parallel, then it is appropriate to use your key rate duration. And this is then definitely used to identify shaping risk, right? Which tells us that what is the bond sensitivity to changes in the shape of the benchmark yield curve, right? Very, very interesting. And the curve could flatten, right? So if it's like this, it could become flat, right? Or it could become more steep, it could steepen. So all these type of changes can be there. Now, how do we go about it? So let's say if we have a bond, right? Or rather, let's say we have a portfolio, and this is for 1 year, 2 year, 3 year. And for each of these key rates, we'll take a duration, we will separately measure the duration here, duration here, duration here. And then whatever is the amount of cash flows, we will take the weight. And so let's say there's $10 coming here, $10 coming here, and $110 coming here. So the weight for this will be 10 over the total, which is 110 plus 10 plus 10 is 140, right? So, no, sorry, 130. 130 and 130 and 130. So you take the weight for each and you multiply with the duration and you calculate a weighted key duration, which is the total entire portfolio's duration. And of course, as always, we have a question for you to help you understand this in a better way. So look at this portfolio. What we have got over here is the cash flows divided across these maturities, these 10 years, 2-year, 5-year, and 10-year. And the dollar amount is obviously given over here in millions of dollars, right? So if you take the total, it comes to 263 million. So very easily you can calculate the weight, right? You can calculate the weight. And for each of those duration, the mod D is given. So if you take the weight, so let's say for the first one, it is 98 out of 263 multiplied with the mod D. So you get the key rate duration for that 2-year. This is for 2-year. And then for 5-year, you take the weight of the 5-year, which is 90.57 divided by 263 multiplied with the mod D of 5-year. And look how the mod D is increasing. As you're going into longer maturity, the duration is higher. And you know that, right? You know that. Because we know that lesser the coupon, higher the lesser the coupon, higher the duration, longer the maturity, higher the duration, right? So we know this. And again, you know, what I want to do is I want to bring you back to the practical scenario of these examples that we saw, Silicon Valley Bank and Signature Bank and First Republic. I mean, what were these guys thinking? By investing in these long-term bonds, right? That's what they did wrong. Because as a bank, they were using deposits and investing in long-term bonds, and those long-term bonds obviously had high maturities, high modified duration because of that high maturity. And when the interest rates went up, when the Federal Reserve increased the interest rates, right, in 2022, 2023, what happened was that those bond prices came down. And I mean, look at this mod D, 9.7. That means with a 1% increase in interest rate, you're looking at a 10% or 9.7% fall in the bond price. And the interest rates in 2022, 2023 went up like almost 4%, 5%, right? So if it falls 10%, if it falls approximately 10% for every 1%, imagine how much it will fall. How much it will fall for 5%. And this is not the bank's own money, this is the depositor's money. How can you lose 50% of it, right? It's just not done. So why I'm emphasizing this right now, that even though you're still at CFA level 1, but obviously you're training to become a charter holder and you're probably going to be in a position where you have to take such decisions. So what you really have to understand, my friends, is that duration is very, very important. And it is so important that we cannot just leave it and say, okay, we're just going to look at the yield and calculate an average duration for the entire bond, split it into the different tenures, the maturities, because for each maturity, the duration is very different, right? It's such an important thing. So that is why the key rate duration is so important, and you'll learn more about this in level 2 and level 3, that how do you take each of those modified durations for the respective year, multiply with the weight, and get your key rate duration for the portfolio, right? So now you know, okay, what is my key rate duration for each of these. And then it's very simple. What you could do is, let me show you. What you could do is you could take each of those key rate durations and you add them up, and that should equal your normal modified duration for the portfolio. So you can take the mod D, right, and weight it out, And this is how we have been calculating the modified duration for a portfolio. So just go back in your mind to the learning module where we said, okay, how do we come up with a modified duration for a portfolio? We talked about two methods. One of them, I said you could add up the cash flows for all the bonds and then calculate the MACD. And based on the MACD, you can calculate the mod D. Or you could just take the approximate mod D of the different bonds and take a weighted average. Either way, whatever the mod D you can get here will be similar or exactly the same as your addition of all the key rate durations, right? So the mod D of the total portfolio doesn't change, but what you get is a perspective into where this duration is coming from. Where is your sensitivity, right? Where is your sensitivity? Are you having the most sensitivity to the 2-year or the 5-year or the 10-year? And clearly we have a lot of sensitivity to the 10-year. And now if let's say this is your yield curve, and if it's flat, let's say it's flat, and if it steepens, that means the long end goes up. Well, you're going to be having a big problem because you have a significant amount of money in that long tenure, right? So you're going to take that hit, and there is a 2.7% fall that's going to come into your portfolio because of increases in long rate. So maybe based on your expectations of changes in the yield curve, you could position your portfolio in a way where, let's say, if this is about to happen, then maybe majority of your key rate duration should be coming in from the short end. Or maybe the yield curve is looking like this and it is expected to flatten. So if the long end is expected to go down, then this portfolio looks good. Maybe I'll put even more money in the 10-year, because if the 10-year rates are coming down, that means my duration is going to be a good thing for me because my prices will go up, right? So this is something you learn in level 2 and level 3. And in level 3, we have this very, very nice learning module called capital market expectations. And there, if we talk about, okay, what are our expectations of changes in the yield curve and how can we then position our portfolio? So all of this comes together very, very nicely as you go through your three levels. But at the current stage, it's just a high level understanding that you're developing. So just know how to calculate your key rate duration, which is just a weighted average of your mod D. And you can double check this by adding all the key rate durations and also calculating the portfolio mod D and then just comparing the two. Right. Next, my friends, is empirical duration. So actually, you know what? Let's take a break here. Get fresh, and then we'll jump into this.